Hi, I'm Linda Miller, a senior accountant at Blue & Co. This is the second part of our two-part series on bonus depreciation. In this part, we're going to discuss the difference between bonus depreciation and another expensing provision called Section 179. One significant distinction is that with bonus depreciation, you can reduce your income below zero, and there are no limitations on this. In contrast, if you choose to elect Section 179, you cannot use it to create a loss. So if there is any excess 179, you'll need to carry forward this expensing until you have income to absorb the deduction. Some choose to elect 179, thinking that they will use it within a couple years of election, rather than over, say, a 7-year prescribed life for an asset. Another key difference is that with bonus depreciation, you must deduct the relative allowed percentage under the bonus depreciation rules of the asset's costs. You cannot elect up to the prescribed percentage. It's all or nothing. In contrast, Section 179 allows you to deduct any dollar amount within the specified thresholds for the year. This flexibility empowers taxpayers to choose the deduction amount and preserve some regular depreciation for future use. It's very important to note that bonus depreciation is the default provision for your business depreciation, unless you elect out of it by class. Also note, businesses can take bonus depreciation on a 5-year asset and not 7, and the same with other class lives. So there is some flexibility for planning, just not as much as under 179. Also, on a state note, you will need to keep in mind that many states do not allow 100% bonus depreciation. Therefore, if you use bonus depreciation for federal purposes, you may need to consider 179 expensing for state tax filings, depending on the specific state rules. For example, some states only allow the original $25,179 election, so it doesn't help a lot, but it's better than nothing. On a practical and long-term planning side of things, the decision to take bonus depreciation for your business is crucial and will depend on several things. 1, how capital intensive your business is, meaning do you purchase $1 million of assets every year, or do you purchase $5,000? Large swings in capital purchases every year can make annual taxable income swings massive if you take bonus depreciation. Consistency in taxable income is sometimes best, so there are no surprises in the future. 2, interest rates and tax rates for current year tax returns versus future rates. Of course, some of this is speculation. 2 years ago, saving tax from a time value of money standpoint isn't as big of a deal as it is now. 3, timing of purchases and cash flow. You don't want to buy things you don't need. You also don't want to take a bunch of depreciation only to have it whipsaw you in a year if you have cash flow issues. Remember, depreciation is all timing. Many people manage their businesses on a book basis and not tax. If your businesses use all of the depreciation in a previous year, sometimes that fact is forgotten. As you have seen, there are many complex layers to bonus depreciation after the Tax Cuts and Jobs Act of 2017 that are just now taking effect. Since depreciation elections can have both positive and negative effects on your tax situation, it's best to consult with your trusted Blue & Co. tax advisor and visit us at blueandco.com for additional thought leadership topics.